Let's jump right in. Today, we're looking at one of the most fascinating, kind of head scratching stories in the market as of August 2026. We're breaking down Tango Therapeutics, ticker symbol TNGX. This is a clinical stage precision oncology biotech company making massive waves. They're focused on discovering and developing novel drug targets for some incredibly tough non-CNS and CNS cancers. On the surface, the momentum here looks absolutely unstoppable. But, as we're going to see when we put on our analyst hats and apply strict financial frameworks, we're talking the legendary methodologies of Warren Buffett, Peter Lynch, and Benjamin Graham, this explainer reveals a completely different story.
309%. That is the staggering one-year return this stock has delivered. I mean, if we zoom out even further, you're looking at a 686% return over the last 3 years. The stock recently rallied from a 52-week low of just $6.25 all the way up to highs over $34. It's currently sitting right around that $27 to $28 mark. When you see a chart moving like that, it instantly grabs your attention, right? It practically screams that something monumental is happening behind the scenes. Or, well, at the very least, Wall Street is convinced something monumental is happening.
But here is where we hit a massive brick wall of reality. This right here highlights the central paradox of Tango Therapeutics. On one side, you've got a massive $4.4 billion market cap. The market is valuing this company like an absolute titan. But on the other side, $0. That's their Q1 2026 revenue. Literally zero. And to go along with that zero revenue, they posted a net loss of over $45 million in that exact same quarter. So what does this all mean? Well, this is the reality of a clinical stage biotech. You are entirely pricing in future success while completely discounting the present reality that they have absolutely no approved products and zero recurring product revenues.
Section 1. The defense. The bull case for TNGX. Let's dive into exactly why Wall Street and institutional investors are so obsessed with this stock. It all comes down to the science. Tango's lead candidate is a drug called vopimetostat. Now, in clinical trials for second-line pancreatic cancer, which is notoriously difficult to treat, this drug demonstrated a median progression-free survival of 7.2 months and a 25% objective response rate. Okay, let's translate that out of the medical jargon for a second. An objective response rate basically means the tumor actually shrank by a predetermined amount. Getting a 25% response rate in this specific, highly aggressive type of cancer, that's a huge deal. It's a real game changer. This clinical data effectively validates the company's entire scientific approach. It's that exact proof of concept that makes a $4.4 billion market cap seem like it might actually be a bargain, assuming this drug actually makes it to the finish line.
And the market is treating that data like absolute gold. Let's rapid fire through the major green flags driving all this hype. First up, Guru Focus gives them a moat score of 6 out of 10. That indicates a strong, narrow economic moat based on their innovative R&D and valuable intellectual property. Second, analysts absolutely love this stock. The consensus is a strong buy with an average price target of $44.33. That implies over 60% upside from current levels. Add in some strategic collaborations with other biotech firms like Araska and Revolution Medicines and, well, perhaps most importantly, a 119.67% institutional ownership. Think about that for a second. That means the smart money, the professionals, own essentially the entire float. That is some serious heavy-hitting validation. Now, here is a number that is absolutely crucial, $379,840,000. Why? Because biotech companies burn cash. It's just what they do. They spend millions on trials for years before ever seeing a single dime of revenue. But Tango has a pristine balance sheet to support all of this. They're sitting on nearly $380 million in cash against just $33 million in total debt. That gives them an exceptional current ratio of 27.38. So why does this matter to us as investors? Because it means they have the liquidity to fund their clinical development without having to constantly issue new shares and dilute your ownership right now. They actually had the runway to let the science play out.
Section 2. The prosecution, the bear case, and the 7 red flags.
Now that we've seen the hype, let's halt the momentum for a second and look at the actual business fundamentals. To understand just how stretched this valuation is, we're going to use a classic value investing metric, the Graham number. Named after Benjamin Graham, the literal father of value investing, this is a highly conservative calculation of a stock's intrinsic value. It's based purely on its earnings per share and its book value. The Graham number doesn't care about hype, it doesn't care about clinical trials, it just asks, based on the actual money you're making and the actual assets you hold today, what are you worth? It's basically the ultimate reality check for a stock's fundamental value. And this brilliantly illustrates just how violent the disconnect really is. The current stock price is floating around $27.50. Now, the GF value, which estimates intrinsic value, puts it significantly lower, at a maximum of $10.21. So it's up to 186% overvalued just by that metric alone. But look at the gram number. It sits at a mere $2.16. At 27 to 28 bucks a share, Tango Therapeutics is trading at roughly 12 to 13 times its conservative fair value. The stock is floating completely untethered from fundamental reality, entirely reliant on future promises rather than present performance.
But the red flags certainly don't stop at the valuation. Their overall GF score is a below-average 47 to 58 out of 100. Their trailing 12-month earnings per share is negative 83 cents. And honestly, it gets worse. Their future earnings are expected to deteriorate even further, with a projected growth rate of negative 23.15%. And here is the one you really, really need to pay attention to: insider selling. The founder and executive chairman, Barbara Weber, recently sold over 30,000 shares. The president of R&D executed a derivative sale of 27,000 shares. Guys, when the executives who know the absolute most about the company are cashing out millions of dollars at these valuation levels, retail investors need to pay very, very close attention.
Section 3. The Expert Panel. Graham, Lynch, and Buffett render a verdict.
As analysts, we don't just guess. We use established financial frameworks. And applying these legendary lenses to this highly speculative stock, well, the consensus is unequivocal. And honestly, it's brutal. All three frameworks flat out reject the stock based on objective mathematical certainties. First, looking through the Peter Lynch lens, we assess growth at a reasonable price. The golden rule here is a PEG ratio below 1.0. Well, because Tango has negative earnings and negative future growth projections, the PEG doesn't even exist. This gives them a negative $3.73 intrinsic value calculation. Next, applying the Warren Buffett framework, we're looking for companies with wide economic moats and high returns on capital. While Tango does have that narrow R&D moat we mentioned, it posts a catastrophic negative 38% return on equity and negative gross profits. It's actively destroying capital right now. And finally, Benjamin Graham's defensive checklist requires a stock to be profitable for the last 5 years to ensure a margin of safety. Needless to say, Tango fails Graham's absolute rules instantly.
So what's the bottom line here? It's summarized perfectly by this famous Warren Buffett quote: "Price is what you pay, value is what you get." The takeaway for us is that Tango Therapeutics undeniably has a genuine scientific moat. Their R&D is highly innovative, and their intellectual property could prove to be incredibly valuable in the fight against cancer. But at $27 to $28 a share, you are paying a massive premium for clinical hope. You're not paying for actual cash flow. You're not paying for consistent earnings. You are taking on extreme valuation risk without any fundamental margin of safety.
Which leaves us with this final question. Can Tango Therapeutics turn their highly promising pancreatic cancer data into an actual FDA-approved, revenue-generating product before the gravity of their extreme valuation and cash burn pulls the stock back down to earth? If you're a speculative biotech investor, this absolutely belongs on your watch list. The science is just too good to ignore. But you might want to wait for a significant pullback. Keep an eye out for a drop back to that $10 GF value range, or, hey, even closer to that $2 gram number range before taking on this level of fundamental risk. Stay focused, stay objective, and always run the numbers. See you in the next explainer.